Hey everyone, Merry Christmas. Hopefully you are enjoying your Christmas day. I know that a lot of businesses are closed today, and hopefully you're having just a great week. You're having a very nice winter. Stock market's been having a great year, so it's fitting to kind of relax a little bit and have a day off. Stock market is not open today. It'll be closed, and we'll get back into it tomorrow as well as Friday. I thought I'd do some live streaming. I am watching the football game. It's a good one. Kansas City Chiefs, Pittsburgh Steelers. And the Steelers have a reason to play. They both have a reason to win. If the Steelers can win, I think they're going to continue their fight against the Ravens to take the top spot in the AFC North. On the Kansas City Chiefs side, they're trying to get the number one seed, and they got to keep winning, or the Buffalo Bills are going to potentially take it from them, because the Bills, I believe, own the tiebreaker since they beat the Chiefs earlier this year. So I think both teams are showing up to play. This is the first time Netflix is showing a football game too. Relating to stocks, Netflix is trying to get into live sports because Amazon, through their Prime service, they have successfully been showing games where they've shown Thursday night games for quite a while, and they've showed live sports, and they've done quite well with it. Also, Netflix has done well with like the Formula One. It's more of a documentary show, but the F1 show has just been incredibly successful. I know I watched the F1 Drive to Survive, show, and it's probably one of my favorites. And Netflix has also shown some documentaries on like quarterbacks and wide receivers for the NFL. I think that's really successful for Netflix. So they should keep doing it. So far, so good with the telecast. The game's on just as you would expect it, whether it be on regular TV, linear TV, or if it was on Prime. It's streaming just fine. I know they partnered, I believe, with Prime or Amazon Prime to produce this particular game. So this could be a nice stock boost for Netflix. If they pull today off, I think investors are going to show up tomorrow and buy into Netflix stock because the game came off really well. Not too long ago, they put together that fight between Chris Paul and or was it Jake Paul and Mike Tyson, and it pulled me in. I'm a Mike Tyson fan, right? I'm 56, and Iron Mike Tyson was, man, he was incredible in his prime. And the Netflix, I guess, producers put together that fight, and was probably more for show than it was for, a athletic sporting event, because it wasn't much of a fight after all, but I think it was successful in getting eyeballs on screens. It was interesting. The buildup was interesting to see if, a great champion at an older age could beat a younger amateur. And the reality was that Father Time is undefeated. As we get older, we get slower. Our strength goes away. And even the great Mike Tyson is being defeated by Father Time. Oh, well. Good news for stock investors is that Charlie Munger was a successful stock investor well into his late 90s. And may he rest in peace. He was a great investor. Now, Warren Buffett's in his mid-90s. He's a great stock investor. So it's not like athletics where maybe your prime years or your 20s, maybe early 30s. I think investing, you just keep getting better and better each year. By the time you hit 50, 60, 70, man, you're getting into your prime. I haven't even reached my prime. That's exciting. Looking forward, seeing, how much more money I can make. 2024 has been a good year, but I think it could even be better next year, maybe 2026. So, N. Kiter, the female fight was much more interesting. You are correct, sir. Ed Kiter, I got to hand it to you, buddy. It's been a pleasure to have you in the community. You always have insightful, well thought out comments, and this one's just a great example of one because you just pointed out something that is very true about that Tyson fight. And obviously they pulled you in, they pulled me in, and it was kind of like the talk among my friends and business contacts the weeks leading up to the fight. We were talking about that fight. So it was a really good idea that these guys put together. So, I give Netflix really a lot of credit for continuing to grow from, being a streamer. And they've been a really good company that's pivoted over time. If you consider my first experience with Netflix was we were coming out, or we were in the DVD era, right? We saw movies on DVDs. We'd stick them in our DVD players. We'd watch movies, and Netflix allowed you to rent them. And the business of rentals was you would go somewhere, you rent that DVD, you'd bring it home, play it, then you return it. Well, Netflix said, hey, we're going to save you the hassle. You just order up what you need on the internet. We'll ship them to you. And then you mail them back because you'll have some envelopes that we include. You put them in the mail and they go back. That was the first service that I subscribed to. I've been a customer ever since. So I'm probably, along with millions of customers, a good customer of Netflix's. And what I give them credit for is they abandoned that model and bet the whole business on streaming. They actually offered themselves to the big company in the space at the time, which was Blockbuster. They said, hey, Blockbuster, you're bigger, you have more capital. We think streaming is going to be the future. What do you say you acquire us? And then you build this streaming business. And Blockbuster said, no, thank you. We don't believe in that. You guys are crazy. So Blockbuster obviously lived to regret those words of turning down Netflix. And Netflix is now a $398 billion market cap company that is just flourishing. They're up 91% this year. Very good return. What's interesting about Netflix is there's been some doubters, and the doubt really existed not too long ago. Look at that. Big drop. Scott's due diligence coming in. Thank you so much, Scott. That means a lot, man. And since it is Christmas, let me extend a big thank you to you on my behalf, but I think on the behalf of a lot of viewers of your channel. I really appreciate all the videos you produce. I watch them. I learn something. I get more information on my investments. I usually, I might analyze a company and then I want to hear how you analyze a company. And sometimes we're right there, very aligned. And once in a while, I got to double check my work because I see something you picked up on and I get better at it. So thank you so much for the sponsorship of the live stream today. And we're going to be streaming together, Scott's Due Diligence and I, this Saturday. It's going to be at 11:30 Pacific, whatever that ends up being on your side. It'd be great to have you. And we'll have Scott, answering questions, maybe sharing his screen, analyzing companies, talking about topics. So back to Netflix. So Netflix, was a great buy not too long ago. I think it's gotten a little expensive now, but I think they have the momentum to grow into their valuation. A valuation of 52 on the PE side is a little high. Even analysts are saying, hey, it's a little expensive. But let's take a look at their growth rate and their margins. Their growth has slowed down during some years, but look at that. It's beginning to grow a little faster. In fact, the last 2 quarters have looked good. 15% in Q3, 16% in Q2. Nicely done, Netflix. Top line is growing nicely. When we look at this business, it's growing nicely. It's producing free cash. I want to take a peek at their gross margins are 45%. That's very good. They do have a lot of production cost. Netflix is finding themselves having to create a lot of content, which could be very expensive. And the movie business, everybody remembers the movie that made lots of money, like Avatar, as an example. Avatar is a movie that I forgot what the production costs were, like $1 billion or something. And it made a lot of money. The studio made a lot of money. But a lot of movies lose considerable amounts. And that's becomes really risky for a studio. And Netflix is somewhat of a studio in themselves, and they're having to, spend a lot of money and risk a lot of capital in making these movies. So far, so good, but that's just one of the risk items that I see in Netflix. They don't have a big giant library like Disney or Warner Brothers. They actually have to pay to use those libraries and put them on Netflix. But all in, I think they have a very strong and loyal customer base, me included. I think I've been a customer, 25 years. For as long as Netflix has been around, I've been a customer. So there you go. I don't even have like a phone anymore, like dial up or, the phone that I have wireless. I gave that up years ago, but I've never given up my Netflix. Mr. 123 Cheetah. Blockbuster had too much late fee. Netflix. Yeah, exactly, man. Wasn't that a pain in the neck when you'd go back with your DVDs and they'd be like, hey, man, sorry, but you owe us $20 on a DVD that costs like $10. It's like, oh, man, frustrating. Yeah, agree. Smart videos on Scott's due diligence. Awesome videos on his channel. And Scott is long on Netflix. I think that's one of your positions, and good for you. You've made a lot of money at it, and congratulations with that holding. It's been a good one. I've been in and out of Netflix. I was in, I got out, and looks like I left the party too early because it's been going up consistently. Look at that, 91%. Back to their financials. So their margins are around 45%. That's very good. And their free cash flow is looking good. I believe their balance sheet, just to take a peek at it, should be in good shape. Debt's $18.5 billion. Cash is $9.2 billion. Net debt is $9.28 billion. And their EBITDA is more than that, so they can pay off debt in 1 year. So it looks good. Looks really good. My valuation on Netflix is, I think they're overpriced. They're priced a little too high, 7%. Now, I think it was a mistake for me to sell Netflix. And I think a company like this is just going to continue to grow and expand their multiple as well as their revenues and continue to grow into a greater valuation. Hindsight's 2020. But I think it was a mistake selling this. But at least I was, I guess, wise enough to buy it in the first place and make some money on it. So this is just a quality company. It's a part of the future. The one thing I'd like to see Netflix do is diversify a little better. Right now, they're kind of a single business kind of entity, and they're getting into sports and stuff, which is good. Speaking of sports, Kansas City's up 6-0 over Pittsburgh right now. We're still in the first quarter. But how can they diversify? Because Netflix is competing against some really strong, powerful, diversified businesses. Google Alphabet, right? The YouTube business is actually the number one streaming service now. More people stream on YouTube than on Netflix. And Google Alphabet is very well diversified. So that is kind of a just a structured disadvantage to Netflix, meaning if their primary business doesn't do well, they've got nothing to fall back on. Where Google Alphabet has search, now they have the robo-taxi business and Waymo, they have their Google Cloud business, so they have some diversification. And then the other competitor they have is Amazon with Amazon Prime. And Amazon has this powerful e-commerce business, which obviously it's number one, worldwide for e-commerce sales. And they have their cloud business. They have other businesses as well. And they have a streaming business. So they're competing against some really, really strong, powerful companies. And they compete against Disney as well. But I don't consider Disney a new generation company like an Amazon or, a Google Alphabet. So it'd be nice to see them diversify, maybe even merge with somebody so that they can compete against the big giant companies. Maybe like a Netflix Meta merger might make sense, because I don't think Netflix would be, there's not a lot of overlap between Netflix and Meta. They kind of do different things, but those businesses might complement each other quite well. And can you imagine the exposure you can get on Meta or Facebook, Instagram, and so forth for Netflix? That might be interesting. So, but Netflix is not broken, but just thinking long term, I think they need to diversify a bit and become stronger and able to maybe weather downturns in entertainment. For example, if Netflix maybe had some bad luck for a while, and they had a string of bad movies. They produced, these movies, each one cost them 200, however many millions of dollars. And they spent all that money and it was just a dud across the board. Well, that'd be a really, really bad year, maybe a couple of bad years. And that might be a very tough period for the company. And investors might lose confidence, employees might lose confidence, a lot of the whole market would lose confidence. Meanwhile, their competitors, they can maybe suffer a downturn in entertainment, but their other businesses kind of keep growing, and actually they just continue to flourish. So we'll see. For now, I just congratulate Netflix for their success, as well as the stockholders that own the stock. All right, so if there is a stock you want to talk about, there's a topic you want to talk about, feel free to put it in the chat. I'd be happy to talk about it and go over it. We've been talking about Netflix. We've been talking about the football game that is on. And right now, I believe it's still 6-0. The Chiefs over the Steelers. We'll see if the Steelers can win this game. I think the Steelers, if they win this game, I think it's a pretty good confidence builder for the Steelers. And if the Chiefs win, I mean, they've only lost one game this year. They've just been really, really good. And one thing that I think is interesting about the Chiefs is they win a lot of close games. And they haven't had one game this year when they've scored over 31 points, showing that they can really obviously win close games, and they have very good defense. Hawker 1000. I think it's been a little while since you've been on. It's very nice to see you. Home builders performing next year. That is a very good question. So let's take a look at home builders, and I'll talk about a few home builders and give you my thoughts. It'll give me a little bit of time to kind of think it through, and we'll go from there. So home builders, I believe, are part of the industrial sector, and they're an industry within industrials. So home products. I don't know how to find out. I'm going to look at Lennar. No, it's consumer discretionary residential construction. Okay. So consumer discretionary residential construction. So there's 20 companies in this particular industry going into a sector. And you think DFH, DR Horton, DFH, oh, Dream Finders Homes. Okay. So, so this is one space that it was a positive surprise in, I would say 2021, 2022, 2023 even, is how this space really did well. And I thought when we went into COVID that obviously the economy went down really fast. And I thought it was going to stay down for a while. I also thought that the mindset of the consumer, especially around such a big decision like buying a home, they were just going to be very reluctant and they weren't going to buy any new homes. But I was really surprised to see how well the stocks did in 21, 22, and I think 23. But the trailing 12 months were DR Horton, they're down 6%. Lennar is down 6%. NVR is up 18%. If we look at the space, I wonder if I can get. Here we go. So this is the 1 month year to date change. I was hoping to get the whole industry and see how it's been doing, but I'm not going to get that. So it's been kind of a mixed bag. Some home builders have been doing quite well. Toll Brothers have been doing well. Champions has been doing well. And I think you really like Dream Finders, which is down 33%. Let's take a look at that. And we'll also look at somebody who's really doing well, Capco Industries. I think these guys are manufactured homes, so we'll look at those guys. Toll Brothers is doing really well. Then we're going to look at Lennar because I'm familiar with Lennar. I owned Lennar for a while, sold them. I sold them because I think I sold them in 2021. I thought, okay, I made a little bit of money, but I think they're going to have a tough time going forward. And I was wrong, but that's that. So this company here over the 1 year is down 33%. Dream Finders is 2.24 billion. Revenue is 4 billion. They have really low PEs, and analysts think they're very discounted. These guys are growing. They grew very quickly in 20, 21, 22. Like I was saying, very surprised as to how, people were willing to buy homes during COVID, and people's lives were like upended, and a lot of things were kind of changed, and some jobs were kind of put at risk. But the scarcity in homes created a big opportunity for home builders, and they filled in that gap of inventory by putting out new homes. Existing home sales and existing home inventory really went down. People didn't want to list their homes. They were afraid to list their homes because they didn't want people walking through their home and spreading COVID in their home, getting them sick. So that's what created the scarcity, and the home builders benefited from that scarcity in homes, and they filled in that gap. These guys really benefited then. I'm curious to see how their stock has done over the last 5 years. Let me look at it on Google and see what that's all about. All right, so 5 year, you could see that, man, it's sold off. Even though they were growing their revenue, it was selling off because you look at their financials, right? In 2020, they were growing. The stock price wasn't really going anywhere. Now, the market realized, hey, this company's doing great. And then it started to really work. I mean, at one point, you were up 400% on this stock because it went from $10 to above 40. But since then, since hitting that peak, it's come down from that peak about 45%. It's at $23 or $24 a share. So is it going to go up or down? Let's take a closer look at the fundamentals and see what they look like. So they continue to grow. I'm going to look at the quarterly to see if the quarterly is actually better than the trailing 12 months. Looks like they hit a low point in the fourth quarter of 2023. And that was a low point. But their Q3 of 2024 was really good. Okay, so they continue to grow. Nice big company. Free cash flow. They're not producing free cash flow now. They haven't been very consistent on generating that free cash. Their free cash flow margin is not consistent. So that's a little bit of a red flag. I like seeing a consistent cash flow, and they don't have it. Gross margin, 20%. Okay. It's not, wildly attractive. It's not like, a big software company that has 80, 90% margins, or a pharmaceutical company that has 80, 90% margins, or NVIDIA. It's a pretty low margin business. Okay. So we have that. The forecast, I'm curious to see, only one analyst covers it, and he's optimistic about the company. Okay. According to that one analyst, the revenue is expected to grow for this particular year. I agree with that number because we saw the quarterlies coming in just underneath that number. But then it's going to be flat in 25. Now, what do I think about the space? So one thing that's been happening is the inventory for existing homes has been going up. And I believe nationwide, it's up to 4 months. And when you get to 6 months of existing home sale inventory, it could be considered a buyer's market. If you have 3 months of inventory, is considered a seller's market. So right now it's still leaning toward, sellers can get a good price for their homes. And I think home builders are doing all right with the available, competing against existing home sales. But the thing that I would caution you is that interest rates are staying higher for longer. And if you have higher interest rates, it just makes buying a house more expensive, especially since home prices have really gone up a lot. So it's going to be harder for people to qualify into a home. And they're going to have more choices. They have inventory of existing home sales that they can shop around. Maybe find a home that's less expensive in an area they want to live in, because new homes are great. They're beautiful. All new everything. All new appliances. Everything's new. It's a really neat thing. I've never owned a brand new home. The properties I've purchased have been existing, and the one that I live in, we remodeled when we bought it. So the cautions that I would have on a home builder is you may have an opportunity to make some money, but you got to really keep up with existing home sale inventory, interest rates. Like if they're going to stay higher for longer, like in 2025, I don't know that mortgage rates are going to go down a whole lot. They're probably going to go down a little bit. And if you have a negative surprise in 2025 or 2026, it could really hurt the home builders. Home builders are not an industry where you have great wealth built, right? Like if I show you communication services where you have Netflix and Google Alphabet and Meta, you have two above 1 trillion value cap companies, and you have Netflix at 400 billion. That's wealth creation. Home builders are not that type of industry. And home builders have been around for a long time. That said, I think it's an industry that you need to think about. If you're an investor or plan to invest, you need to have your exit strategy defined and you need to stick to your plan, because it's not, I don't consider it a industry that's going to double your money every 5 years for a long time. It's not a meta. It's not, nowadays semiconductors have just been flourishing, Apple technology and so forth. So that's one caution that I would put out there is, if you're going to invest in, keep track of those signals within that industry that are going to tell you what's going to happen to this particular space. And obviously the performance of the company you're invested in. From what I'm seeing, these guys are performing quite well. I mean, operationally, they're good. Let me just double check their balance sheet. I'd hate to see too much debt, but we'll see. So debt's 1.5 billion, 1.3 billion if you consider the cash they have on hand. So yeah, they have about, it would take them 3 years to focus on paying off that debt at their current EBITDA level. The last time we had a very bad environment for home builders was around 2000. Yeah, it was about 2008 when we had the Great Recession. Back then we had a lot of subprime loans that were, lenders were lending money to people who couldn't afford to pay those loans. So it created a lot of foreclosures and it put prices artificially higher than they should be because people were buying homes on adjustable rate loans. They couldn't qualify those loans. So a big glut of homes was put back in the market. A lot of loans were considered to be really bad. And that created a glut of inventory and it created a lot of fear, the Great Recession. That's where The Big Short, the movie came out of. The Big Short was when they shorted the subprime market, the mortgage market. So that caused home builders to go bankrupt and they had a tough time. That debt level is not a problem that if everything continues to operate at the current levels. But if you have a bad surprise and all of a sudden your revenue drops 20, 25%, that is going to be a heavy burden of that debt. So keep an eye on that debt. Right now, it's not a problem. You're right there at the limit, at my limit, which is debt to EBITDA of 3. See how it's 3.38. I consider net debt. If this keeps going a little higher, if some of your fundamentals drop, then this stock becomes riskier. So keep that in mind. So home builders, I'm not in home builders. I'm not going to be investing in home builders, I don't think. I invest in residential real estate and I rent it out to people. I have been looking into a multifamily recently and will continue to do so because I think there may be an opportunity arising soon. We'll see. I've been watching a real estate guy that I really listen to, and he is a commercial real estate guy, multifamily, and he believes that the market's good, but I'm doing my own homework and seeing if it is. So that is the home builder industry. Taking a peek at Lennar. This stock worked for a while. Look at that. That's a pretty chart. Up 148%. I took them for a ride and I sold. Thought, it's not a good place to be. I thought it was smart for a little while and then it kept going up. So that's what I get for getting out of the stock. But more recently, it's really dropped. Last month, it dropped 18%. There is concerns out there. When I think the Federal Reserve decided to they communicated that rates were going to stay higher for longer. That had direct impact on home builders because it's like the mortgage rates are going to stay higher. And that's just going to be a headwind for the industry. So that's what caused that. I think the space, you got to pick the right one. And again, have a good exit plan, monitor your companies well. I encourage you to analyze them twice a quarter. Obviously when they announce their earnings, go through everything, look at them. And then in between quarterly announcements, take a look at them, see what's going on. If you don't have time to analyze your companies a couple of times a quarter, maybe you can lower the number of companies you own. If you enjoy it, like I do, you just get to do more if you have more companies. So, all right. So I gave you a nice long answer on home builders. Thanks for asking. Good luck with DFH, or I don't know if you're invested in it, but if you do, good luck with it. And Kiter, Home Depot. So let's talk about Home Depot. Home Depot are they a way of playing in a home building? Yes, kinda. It's near home building, but it's not quite the same. Home building, right, is, in my opinion, far riskier. When you think about home building in the US, I got this AI app now, right? I can ask it whatever. What is the medium price of a home in the US? So what's the median price of a home? So we got $430,000. So home building is about creating a product in one unit. You got to find a family, not even another business, right? You're finding a family that wants to commit to paying $430,000. They'll probably finance most of it. In most cases, they put down 20% or less. In many cases, if they're a first-time buyer, they can do first-time buyer programs and put down like 3% or 5%. If they are a veteran, I believe the veteran programs allow people to buy homes with a very good rate. And I don't know if they have to put a down payment. So that's good. Support our veterans. That's great. But when you're comparing this business, in 1 second, when we compare home builders to walking into a Home Depot and buying, a lot of the product at Home Depot is maintenance and repair, and then some remodeling, as well as gardening and a variety of products that you find there. So Home Depot is far more like repeat business, right? Like my furnace, the filters for it, and I've got 5 properties to manage. So I'm buying air filters all the time. That's an example of repeat business for Home Depot. I'm going in there and buying air filters. Also things that tend to break often, you're buying them there. Plumbing supplies, things of that type, light bulbs and that kind of stuff. And of course, big ticket items. In our home, we refreshed our appliances, I would say, in the last 2 years. And where did we get no, we didn't go to Home Depot. We went to another retailer that just focuses on appliances. And refreshed our kitchen appliances. But that's the kind of stuff you'd buy at Home Depot. So it is a little bit, I think they are connected, because as housing starts go, Home Depot stock tends to move. If housing starts go up, Home Depot stock goes up. But it's not quite 1-to-1. I would say that Home Depot is a little more diversified. It's also far more valuable. And this kind of proves my point that home builders, are home builders long-term wealth creators? Well, home builders have been around longer than Home Depot. But Home Depot has become a $393 billion company because they're a store that sells the stuff to maintain your house or your apartment, or buy stuff for your house or your garden. And I bring up the garden because I'm in California. We do gardening out here. And we buy quite a bit of stuff from Home Depot for the garden. So it's kind of a just reoccurring thing. They also sell janitor supplies and even some like car care supplies in there too. So Home Depot, how are they doing? Over the last year, up 13.6%. They pay a 2.27% dividend. Not bad. Not bad at all. This is a safe stock. Home Depot is going to be around. And, the brand is really, really strong company. And these guys over the 5-year, 80%. It's pretty good. You add that dividend, you're probably adding 12, 14% on top of this 80%. That's a really good stock. For a while, it's kind of going sideways, but it's beginning to move upward. So that looks good. Let's take a look at their revenue, see what's going on. It's a flat sales situation, although their latest quarter looked good, up 6.65%. Maybe that's why the stock's beginning to go up. So their gross margins, 33.38%. That's very good for a retailer. That's really good. If I show you like Kroger, which is grocery, I mean, Kroger is nowhere near 33%. So for a retailer that's doing the kind of volume these guys are doing, which is 154 billion in revenue, it's very good margins. Very good. Okay, so that's good. And free cash flow is good. So would I pay? So their free cash flow margin is 10% on revenue. I think Home Depot is priced a little too high. I think the best I can do is maybe get up to like 300 billion is where I'd probably land. And it's probably because it's been rising nicely, especially kind of like mid-year. It started to rise really, really well. I just don't see that they're going to grow very fast. They're very big. I think they've had a period of plateau sales. And so I'd probably not value the company at but 393. I'd probably be less than that. Some analysts, probably a lot of analysts cover it. 27 of them. And on average, they think it's still discounted by 7%. And they're using earnings per share. They're expecting, for a company their size, pretty good growth, like 3.4% in 26, 7% in 25. You see, this year, we're actually in this year. This is going to end in about a month. This is, I think, referred to as the retail calendar. And there's a reason why they end pretty much at the end of January is because you sell so much during Christmas that people return things at the beginning of January, and they can then net the returns from their revenue. Then they don't misrepresent what the year was all about. But we're in this year, and it's going to end January 28th. So really, this year we're in it. They're growing at about 7%. I saw that. The year that begins January 29th of 2025, the growth is going to go down a little bit. So I'm not wildly excited about this. It's not like, wow, these guys are growing great. It's just a very trusted brand. People like Home Depot. They know what Home Depot's about. They probably a lot of investors buy the stock because like they remodel their kitchen and spend $20,000-$30,000 at Home Depot. And they're like, geez, I got to buy some of their stock because they're making a lot of money because they just took $20,000 off of me. I'm sure some of that happens, but it's 26.9 PE for the current year, 25.4 next year. So overall, this is not a company I'd look to invest in, but that's just for me. Good income stock. I'm careful not to buy too many retailers. Right now I have Kroger, which is officially a retailer. And Yeah, this is just a comfortable stock for a lot of people that can understand the Home Depot business and invest in it. And I think, is Home Depot part of the Dow? I think they are. It's a Dow stock. I think it's a good idea to have it as a Dow stock. And I think it does represent a lot of things of what's going on in the economy. I don't think they've been plagued. You know how a lot of retailers like Macy's in Southern California has been plagued with a lot of theft, and the theft is getting just got really bad. I think they're doing something about it, so it's improving. But the thieves were actually getting violent with the security people in the stores, which just makes a bad situation just way worse, right? If you have security guards that are being injured and that kind of thing. Um, I don't think that's been occurring at Home Depot. I don't think people are running in the store and grabbing 2x4s and then trying to run out. But at Macy's and places like this, they grab merchandise and try to walk out with it or run out, which is unfortunate, right? Everybody loses in a situation like that. Um, that's one of the reasons that, it's a tough business to be a retailer, to compete against Amazon and Alibaba, Mercado Libre. That's a tough proposition in today's era where everybody's got a smartphone and can shop, using their fingers. But Home Depot has a different business, right? Again, if you need plumbing stuff, whether it's pipes or faucets or whatever, you go there and you usually find some knowledgeable plumbing people there too, by the way. You can watch a few YouTube videos on how to improve something in your home or fix something. Then go talk to the Home Depot plumbing guy and they get you squared away. Hey, I need this, that, and the other. You even show them the video. And they're like, oh yeah, go over here. Here's the stuff. And you go and you fix the item. And away you go. I found that working on houses, and maybe that's just the way I was built. I have a brother that's has worked on diesel engines. I come from a family of like mechanically inclined people, like rebuild motors. Like I rebuilt a motor with my older brother when I was 11 or 12. And it was pretty cool. I was turning wrenches and he was making all decisions and stuff. Now, fast forward, I know the fundamentals of motors, internal combustion engines, transmissions, and so forth. I know all that stuff. But if you asked me to fix a car on a regular basis, I'd probably, barely get things done. But when it comes to houses, I've been pretty good at it. At the same time, I come from a family where we have a lot of tradespeople in our family. And I've been able to do plumbing, electrical, a lot of structural stuff. I'm able to do it now that I'm older, right? I just don't have the strength. Back to the Mike Tyson story I started with, is I just can't work physically the way I used to. But I do enjoy, like, I added 500 square feet to the house I'm in. I did all the electrical, the plumbing, and some of the finish, and other people did the rest. But I enjoyed doing part of the work, is where I'm alluding to. And I think Home Depot, I've spent, I got to think, well over $150,000 at Home Depot in the last 20 years, maybe $200,000. And because of all the remodels that I've had to do, like I've got a unit that's going to be unoccupied in about 4 months, and it was going to be unoccupied at the end of this month, but he's asking for an extension, which is fine. And I'll have to refresh that unit because he's been in there for 5-6 years. So you got to go through and paint, probably do new flooring, and it'll probably be like a $2,000 to $5,000 changeover. And a lot of those dollars will go to Home Depot. So Home Depot is there. They get a lot of money because people continue to need to repair and improve and keep their homes comfortable. All right. So it looks like the Kansas City Chiefs are up on the Steelers 13-6. The Steelers just scored. Russell Wilson ran the ball in. and scored. I think he had a turnover earlier in the game, which I think is a difference maker at this point. They are playing the game in Pittsburgh, and I think Pittsburgh is tough. Those guys, they play tough every time. So we'll see how it goes. All right. So thanks for the question on Home Depot and Kiter. And hopefully you found my comments interesting. Again, I think Home Depot is a quality name. A lot of people in Home Depot. You're up 25%. Atta boy. And I think your money's safe with Home Depot. You know, it's just a good, very good company, good stock. All right. So Hawker, did I cover? So Hawker 1000. Another question. Yeah, that's a question. So when do I decide to sell a stock? And there's a couple different ways that I've seen, like, you know, the execution. There's no, like, you know, perfect formula or, you know, sequence of events leads to this. I would say that what would compel me to sell, there's some situations. First, if the business is quite a bit different than I expected, like too many negative surprises came up, and I'm just like guessing at that business, and I just lost, you know, confidence in the business, that would be a sell. Okay. Oftentimes that's accompanied with the stock is suffering. It's going down a lot. Those are a little more obvious, like, hey, like Intel. Intel was just, it was really bad in 2024. But let's think about when a stock is going up and, you know, the exit strategy there. Now, I've sold stocks at good gains and have been happy that I did so. And I've sold some stocks, good gains, and regretted it. And I tried to follow the principle of, you know, I don't want to be greedy. And I did believe that the stock was unappreciated. It did achieve a certain price level, and I'm satisfied with the return. Like TSM is probably one that I sold at the right time. It was either luck or. So I owned TSM for a while, and I sold it right ahead of the big downturn of 2022. I probably tripled my money on TSM. It was a very good stock for me because I owned it for a while. That one really went well. One that recently went absolutely wrong has been Broadcom. So I was like, semiconductor has been good for me. Like, I made money on TSM. I made money on Broadcom and thought, hey, Broadcom's a good buy. I got to like this point, you know, it was a good returning stock. And I'm like, you know, that's enough money. Thank you, universe. I'm out. And the stock just took off. And I think Broadcom is overpriced. So there's no perfect, you know, recipe. Hindsight's 2020, right? And in a market like the one we're in now, where we have the last 2 years have been this really nice upward trend. Yeah, it's easy to see that, hey, holding stocks longer was the right move, because if you held Broadcom longer, great job. If you held Nvidia longer, great job. If you held Palantir, Netflix, Meta, then you're just crushing it, right? But when you're making the decision here, and you don't have, a crystal ball that tells you, oh yeah, stocks are just going to be going up and to the right for the next 15 months, then you're making decisions, at that moment. Where are we heading to next, right? Are stocks going to continue to go up and up and up? I don't know. I would just say that having experienced, not getting as much return as I should have gotten, or I could have gotten, I should say, on Broadcom, I'm going to be a little slower to pull the trigger on sales going forward. I think I've learned the lesson, and I've had to pay a lot of money to learn that lesson by my sale of Broadcom. I also sold to Amazon. I regretted it and jumped back in as fast as I could. I probably did lose some money in that whole transition, but Amazon did great. I sold. I really regretted it. It pulled back. It gave me a chance to get back into it. And now I'm back into Amazon. So there's some things that could also compel you to, sell a stock, which would be, let's say you had another opportunity present itself. For example, in 2010, the subprime market meltdown happened. And we had properties like in Orange County, which is a really nice place to live. Home prices went down 40% from the peak to the very bottom of the trough. I'd never, like, I think I studied the history books, and that never happened. So prices had gotten so low. It was a really big opportunity. Nobody wanted to buy homes. Nobody wanted to invest homes. So investing was like a really good opportunity. So I actually sold some stocks, tapped into investments that I had, drew my savings and went into real estate. And each property would cost, $50,000 to $100,000 to invest in. And it was a really good idea. Each property, I multiplied those investments, handsomely. One that I invested in 2012, I ended up investing like $75,000, and I sold that property in 2022. It had a gain of about $605,000, a realized gain. And each year, that property toward the tail end, the last year was cash positive by $65,000 per year. That was a phenomenal return. So that could cause me to sell a stock, which is if another opportunity is out there where, hey, I need to raise cash, well, go sell some stocks and just look at your list of stocks and start going from, kind of like sort your list from the weakest on top to the strongest on bottom, and just start, considering, okay, I want to sell these weak ones because I have this other opportunity and I want to go tap into that opportunity that's come up. It could also be a life event, right? I have 2 sons, and I want to help them buy a house. And if either one said, hey, Dad, I'd like to buy a property, and properties are expensive, and they'd be like, cool, let's do this. Let's get the specifics. And if I needed to come up with 100, 200 grand, I would come up with 100, 200 grand. And that might compel me to, again, look at the list of my stocks, rank them from the weakest on top to the bottom, and clean out the ones that are weak. And that could cause me to sell stock. So I don't have like, the things that I don't like as an investor is oftentimes there's a lot of cookie cutter advice, like, oh, this is the 5-step process of, doing something that's really difficult successfully. And it's like, right. It's never that easy. Every situation is a little different. Every industry and sector we cover is a little different. So I would just say what I do appreciate is experiences that are shared on YouTube. Experiences like, Scott's due diligence. He goes through his numbers. He looks at companies. He shares out his experience. I get more out of that. And then I use my education and accounting and my MBA, I read books. I was given a book for Christmas on, it's a book, I've got it here somewhere, but it's kind of like some of the people that came ahead of Bitcoin that are, we're kind of influencers of how the whole Bitcoin network was created. Look forward to reading into it. But that's the answer I would give you is, I think your situation needs to be, you need to tailor your plan and how you're going to manage your portfolio around you, and continue to learn, you know, I would actually encourage you to take action once in a while. Um, if you never sold a stock, then you don't know how it feels to sell a stock and take a gain, or sell a stock and make a mistake. Sell a stock and realize you did the right thing, right? And with experience, comes skill, and you become better and better and better. And sometimes I like to say that you have to pay for lessons in the stock market. And sometimes I pay a lot for a lesson. Sometimes the market rewards me for making a good decision, like that property I was telling you about. Um, all that is, the Kansas City Chiefs are having a great season. They lost one game. They're not perfect, and they're having a great season. The Steelers are having a good season. They lost 5 games. So I guess you could say the Steelers have made 5 mistakes this year, and they're still playoff bound. So all right, so that's that. Let's keep rolling. So Brian Nelson, thanks for joining. So is CleanSpark a Bitcoin miner? Let's take a look. And then PT, I see ya. Uber, love to cover Uber. Hey, and Kiter, enjoy lighting the Hanukkah candles. Thanks for joining. Neil Weston, Merry Christmas, man. Thanks for joining. Appreciate it. All right, CleanSpark. And Brian, am I looking at? Yeah, I'm probably looking at the right one. All right, so let's get into a miner. Let's do this. So, real personal story that I'm going to talk about, which is so I don't know how many dads are out there and moms, but my life journey. My mom turned 89 on the 18th of December, and it was great to spend a part of the day with her. Most definitely, I won the lottery when it comes to moms. She's wonderful, but I get to I've been given the sheer pleasure of being a dad for 24 years and some months to these 2 boys. And the younger boy, this is like 8 years ago, like 2016ish. He came home and he said, "Hey, Dad, I want to start mining Bitcoin." He's like 12, and I'm like, "All right, so tell me, what's Bitcoin?" This is before I started investing in Bitcoin, and he explained it to me, and I'm like, "Man, that sounds like." And I'm a technology guy. I've been working in software for a while, and I'm like, "Okay, I kind of get it, but let's pump the brakes a little bit. Tell me more." And he told me all about it. I'm like, okay, well, what's the worst that can happen? We'll buy a couple of GPUs. He'll learn something. He'll set this up. And we ended up like this picture you're seeing on the screen. He set up his room, and these GPUs create so much freaking heat. I thought he was going to burn down the house. So I was like, hey, buddy, you got to be careful with this because it's really hot, and you have like clothing around it. And so the kid kind of had me on graveyard shift, making sure he didn't burn the house down. But he did that for like well over a year. And I think he learned something. He learned a lot about Bitcoin, and he didn't burn down the house. So it was a successful experience. And I learned, I think it was the beginning of my learning on Bitcoin. And we also, those GPUs, by the way, when he sold them, they were worth more than when we bought them. That also was kind of hey, I didn't know some hardware went up in value, but NVIDIA hardware does. So that was a personal story. Now let's get into a miner. So miners are participating in making the blockchain work. for Bitcoin. And as transactions are being put on the blockchain, their computers are validating those transactions. And I'm not quite sure exactly how the Bitcoins are awarded, but the bigger miners have a big advantage on getting awarded the Bitcoin, that you get awarded because you're providing the support to the network. Ethereum is a different model, but that's essentially what we're dealing with. And this right here, what we're seeing is this is a lot of infrastructure that is participating in the whole Bitcoin blockchain process. And the term mining is they're getting awarded Bitcoin for providing the infrastructure. Now, let's take a look at the fundamentals of this company and see if it'd be a good investment. And I also want to look at their financials, because I have seen, when I looked at miners, I would say that we're going to look at their KPIs. And I've noticed that, so here's a presentation. I want to see your financials. Just show me your financials. Presentation transcript. Okay, I'm going to open up the presentation, but then hopefully they give me their 10Q. Yeah, it's right here. So I've seen with some miners that generally accepted accounting principles, GAAP, is the accounting boards want people to conform to certain ways of reporting their financials. And it's a good idea. That way, if you're looking at Home Depot and Lowe's, right? That's a simple example. The financials should look the same and the businesses are similar. Yet when the standards boards, these are concepts that are like 100 years old, accounting concepts, and they get updated. But I would say there's an appreciation for keeping things the same in accounting, because you want to be able to compare to history. And the Bitcoin industry is so darn new that it forces Bitcoin miners to classify some revenues and even on their balance sheet, some assets in a way that it doesn't look like the value doesn't come out very easily. Or I should say, reading the value of a company makes it is harder. And hopefully we'll see an example of that here. All right, so we have a 10K, and yeah, 10K is good. Okay, so CleanSpark. I'm going to go with CleanSpark. That's CLSK. Now, I like stock analysis because it gives me a nice place to kind of start and kind of do a nice overview. Revenue growth is phenomenal. Now, what helps is you got Bitcoin that's really going up in value, which is very good. But phenomenal growth is phenomenal growth. So this is the revenue, grown really nice. Cost of revenue, electricity, GPUs. I'm sure they have to depreciate those GPUs. And you have your gross profit. So their gross margin is 56%. It's very good. You can see it might vary year to year. And depending on how good they are at mining Bitcoin, and then the price of the Bitcoin itself. But really, it's been good for 4 or 5 years. So it's been doing quite well. So gross margins, so they're losing money. Then the free cash flow, that's where I'm going to look at the financials, because I'm actually going to examine that and see if it's truly negative free cash flow, or are the accounting standards not giving them credit for Bitcoin? We'll get to that later. So remember that 299 negative cash. But I'm curious to see why these guys are losing money. So you have, so their fiscal year ended September 30th. Okay. And revenue 378, gross profit 213, selling operating expenses. Excluding unusual items. So we'll have to look at that. And then an asset write down. Okay. This is a non-cash event. If Bitcoin went down in value, then they'd have to write it down. If they were holding Bitcoin and it went down in value. There's a principle in accounting called conservatism, meaning if there's two options on the table, you'll always take the conservative one. You'll never take the optimistic one. So if you have a write down, you're going to write it down. You're never going to write it up. So keep that in mind, that these write downs are non-cash. And, as we've seen with Bitcoin, it's risen. So it may have been a quarter where you saw Bitcoin drop, but now it's risen. So it's almost like we need to undo that number to really get a clear understanding of the performance of the company. So I'm not concerned about this loss because, as you can see, the Bitcoin industry is a new animal that our accounting standards can't keep up with. Now let's go examine the financials and see if I could show a few examples of what I'm talking about. Whoa, went too big. There we go. All right, so that's easier for you guys to see. And let's get to their financials. Okay, so page 60. Take me to page 60. Okay, so we're in the financials. And this is their auditor. Who is their auditor? I don't know. Subidio. Okay, so here's your balance sheet. They have cash, and this is US dollars of 121 million because it's in thousands. Okay. We have Bitcoin, 431. So we are, and I'm going to note a few things on some paper here next to me. So we have CleanSpark. So we have 121 and then 431. See, I consider Bitcoin, this is cash to me, right? These guys can convert this to cash immediately. So that's cash to me. But I think some reporting standards will not allow the financials to show that. Okay. Okay, that's fine. And let's look for debt. So they owe $7 million and then 58. So this is cash, debt. So they have about $553 million of cash, and they have about 65, call it $66 million of debt. So their net cash position is about $490 million if you just consider the cash they have minus the debt. Okay. So here's their Bitcoin mining revenue. Looks good. This is for the year ended. Big jump from 2023. Okay. Cost of revenues. And here it is. So this is a gain or a loss on Bitcoin. And they're having to take a decrement against the revenue for Bitcoin having this volatility. In my mind, that needs to be undone because, yeah, it went down, but then it came back up. Impairment expense, fixed assets. I don't know what that is. Fixed assets. That could be that a batch of GPUs went bad and they had to like throw them away. I'm not sure what that is. But I could see that they're closer to profitability than the financial statement would lead us to believe. Okay, point made there. Now let's get to cash flow. Okay, so they have this net loss, but of course, see, this is where we undo it, this gain. And then Bitcoin mining revenue. So Bitcoin mining revenue. This needs to be undone because the reason it's being reversed is they're being paid in Bitcoin. I treat Bitcoin as cash. So this is a positive 378. Okay. So I actually think, and let me make sure it's like the impairment fee, that makes sense. Depreciation, that makes sense. That makes sense. So I would actually take 378 and add it to this negative 233 to get my true cash produced in this period. And that's what I wanted to point out about miners is accounting standards force them to not treat Bitcoin as cash. I treat it as cash. I own Bitcoin. I know what it's all about. You can turn it into cash immediately. It's even better than cash in a lot of ways. You can move it much faster with less friction. So that's how I treat it. And that's how I value miners. So I'm going old school. I am doing arithmetic on paper. That's how I was taught arithmetic. 145 million in cash from operations. And that would be for the year ended. Okay. Now let's see, where's the CapEx? So that was, there's no CapEx. Okay. So there's no CapEx. So it's $145.8 million of free cash flow. So what's the market cap of this company? So this is a $3 billion company that is producing free cash flow in my book of $145.8 million if you include Bitcoin. They are growing. They are on a rocket ship ride. They are on a rocket ship ride sitting next to Michael Saylor drinking Red Bulls, saying, man, we got to stay up all night for 3 weeks to keep up with this demand. And so this one here, man, this is exciting. Analysts think it's 103% discounted. 7 analysts cover it. They're going to make money in the fiscal year that they're already in of $1.34, $1.94, and then 87 cents 2-3 years from now. They're going to grow nicely. The super growth is going to kind of slow down. And this is going to be dictated by Bitcoin prices, right? If the Bitcoin is being sold for $200,000 in a year or 2 years, these numbers will be restated higher. So overall, this is an interesting business. And let me check the comments. Maybe we can jump in and do an analysis on this company. You guys liking what I'm talking about and the level of depth I'm going into? I got Uber on the wings here, or on the wait list. I think I can bang it out like in 10 minutes, so I might keep going, but give me a second. So Neil, you like Mara? That's another miner. Very good. Yep. It looks good. Okay. So there's Mara and then Riot. Okay. So Marathon, I believe, and then Riot. Now, every time I'd look at these, and it's been a while since I've looked at Riot, but let's look at Clean Spark. And I'm going to try to fly through an evaluation and kind of guess at what I think the valuation for me would be for the company and see if it truly is discounted. So I have BTBT. It's been a stock that I've liked covering. I've been in and out of it. I'm currently out, but I currently invest in Bitcoin, Ethereum, Coinbase, and okay, so row. CLSK. So you see the discount that I'm using on Bitcoin miners, a much higher discount. Now these guys, I don't know them that well, so I'm going to go with that. Now I just said that my free cash flow number is 145. Now Bitcoin, I expect is going to keep going up. How am I going to grow the first 4 years? I'm going to grow at 10%. I'm not going to be overly nuts about it. So it's plus 145. It's 160. So if they grow their cash flows by 10%, which is a very conservative rate, I mean, they're growing their revenues. So maybe we go 25%. Okay. Then we get to intrinsic value of 3.3 billion. They had 552 million of cash if I include the Bitcoin, and they had 66 million of debt. Their market cap is 312. And shares outstanding 292.56. Okay. So it's discounted, not a wild discount. And I mean, these numbers are really, this is like, when you look at like a really old company, a value stock, it's like trying to hit a moving train with a baseball, so to speak. Maybe it's going 40 miles an hour and you're trying to hit one particular train car. But with a fast growing business, it's like, whoa, it's like an airplane flying by and you're trying to hit it with the same baseball. It makes it much harder. All right. So forecast on their earnings per share. It's cool that there's 7 analysts covering it. It's going to be $1.34 for the current year. It's a good number. Keep that at that number. And what was the growth going to be on 34? It's going to grow at 44%. So I'm going to grow it at 20%. Yeah, so that earnings per share is gonna make this stock look special, especially if Bitcoin rallies. And this is a 12% discount. So I mean, I'm seeing a lot of potential there. Investing in Bitcoin, next generation stuff is very risky, but I invested $70,000 into my Bitcoin and Ethereum, and it's worth $200,000 now. So there's a big return. Coinbase has been a really good returning stock for me. And CleanSpark could be a big winner, but it's very risky. And those are the numbers that I kind of threw together here on this session. I'm going to refine these numbers. I'm going to give myself a note to come back and review these. But that's CleanSpark, man. I think the Bitcoin industry is going to be really exciting. We've got a new administration, and across the board, the Senate and the House, they're into lowering the amount of government. And Bitcoin is not governed by the US, not governed by China. It's not governed by anybody. It is this autonomous thing that is just going to keep going. And I'm excited about it. I think it's going to go to $500, and we'll see if it gets there. This is my off the cuff analysis on CleanSpark. I'm going to add it to my watch list. I'll come back and review it. I'm going to give myself a day or two. I like doing that. Then I can look at the numbers fresh, make sure that I did my calculations right. We'll go from there. All right. So that'll just give me the note to go back there. All right. We dug deep on that one, man. That was cool. Tomas, Feliz Navidad. Hopefully you're doing well. And Tomas, I think about you when I think about Mercado Libre. Hopefully you saw those videos I created, and might be something to think about, or even new holdings, because I know that you're looking for stocks that are growth stocks. So 2 to maybe get your head around. All right. So Magical Self. So you want to, I think it's Goldman Sachs is what you want to look at. We can look at that. We got one person ahead of you with Uber, Goldman Sachs. Take a look at that. Financial services has been really, really good. Yeah, I like Mercado Libre. And, the stock pulled back. What's interesting is I made a video 4 months ago, and I wanted to buy Mercado Libre. And I was like, okay, I'm going to buy it. And then it rallied. And I'm like, oh, I hate buying when stock's rallying, man. Can it just slow down? And it didn't slow down. And meantime, Amazon was dropping. and I switched investments. I'm going to buy Amazon. That was a good idea. And now Mercado Libre dropped. So it's like, hey, I'll take it. I'll take that drop in price. I think it's a good company. So here we are. All right, let's talk about Uber. Uber has been kind of brought down by the fear that robotaxi is going to be more of a, is this real? Like 0% for the year? I guess it is. Recently, Uber has been sold off because the whole robotaxi business model is feared to be, hey, it's going to be more of a risk or a threat than an opportunity for Uber. I don't agree with that. In fact, the leader in robotaxi is Google Alphabet, because they have Waymo operating, I think, in 4 major cities. And they've already made an agreement with Uber. I forgot the 2 cities they're going to cover. I think one is Austin and it might be Atlanta. And Uber, their stock has really been sold off, which, for the past year, it's been a surprise, frankly. Over the 5 year, it's doing well. If you bought at the right times, you're doing okay. I'm buying more shares into Uber because I actually think that the network they have is going to be really valuable to whoever wants to partner with Uber, whether it's Waymo or even Tesla. Uber is partnering with a Chinese autonomous robotaxi company in Abu Dhabi or some big city, I think in the Middle East. And I think that's going to keep happening. So I actually think it's going to be an opportunity for them. And I don't think anybody could say for sure what it's going to, play out to be. What I think Google Alphabet is more of a platform company. They like creating platforms, and then their partners do a lot of the work, so to speak. YouTube's a good example of that. Their YouTube search, right? They provide the platform and people use it for advertising and so forth. Their Google Cloud, it's infrastructure, hyperscaler. They provide the hyperscale capacity, and partners work with Google Cloud, help customers use it. So I think they're going to do the same thing with Uber. And that would be a very good combination of Uber using the Waymo technology and taking on cities and then operating autonomous robotaxi service on Uber. I think the stock is very, very attractive to me, and I've been investing. Right now, it's discounted substantially because this stock's been sold off, but their cash is there. It's growing its cash, free cash flow. I think revenues have been growing. Let's look at the quarterly. The quarterly is at 20%. So their growth is looking really good. International growth is looking good. So I'm seeing really good growth, very good scale, 42 billion in revenue. Margins, 32% margins. They're in a service-based, business. But one of the things that I love about Uber is they don't have to buy cars. They partner with contractors who are going to lease or rent or buy a car and then put themselves on the Uber network and then drive people around. I'm a big customer. I'm sure many of you are, of Ubers. I haven't rented a car in a long time. And all my money that used to go to car rental companies now goes to Uber. So I'm optimistic that the company is going to keep growing, and their network, More than 1 million people take an Uber ride every hour. That's scale. That's number one scale in the marketplace. And I think that's going to be their big moat. That's going to be their competitive advantage. And that's why companies like Google, Alphabet, and Tesla will want to partner with Uber. Like they have the network, and the other company can provide the platform. They can co-share in the revenues and so forth. And who knows, maybe it evolves into something else. It'll be very interesting to watch. But I think selling off Uber, some people are expecting that it's going to go a particular way. And I think they could be surprised that it goes Uber's way. And it's actually a big benefit to Uber. So my position on Uber is just to continue to buy shares. I think they're being discounted. And not the first time that a great company gets discounted. We were covering Netflix earlier in the stream, right? And Netflix kind of dealt with similar, stories where, oh, Netflix is terrible. They don't know what the heck they're doing. Look at them. They're just a bunch of dummies. And the stock sold off like 73%. This is like the number one full streaming company, right? Like YouTube gets more eyeballs now, but at this time they were number one, clearly. The market sold them off by 72%. And investors came in and said, thank you very much. I'll buy that stock and make lots of money. And I think the similar scenario where Uber is being doubted, like, hey, it's not going to be as good and so forth. Right. Like Netflix has a lot of users and they're very sticky. I've been a Netflix customer for 25 years, 30 years. I don't know how long. And I think Uber is my app. Uber is the app for everybody. They're going to stick to it. And they have so many people on their network that it'll be very hard to move them. If Uber offers the service, it's going to be on Uber. And if you think about the comfort level of people wanting to take a robo-taxi, I think you would get the adoption rate up faster if you did it on Uber. If it was completely a brand new service, like Waymo is operating in certain cities, and I don't think the adoption's extremely high. And FYI, I'm a Google Alphabet stockholder, so I know the story on that side because it's my number 2 stock in my portfolio. And but I think the adoption would accelerate if you made people comfortable that, hey, this thing is good enough for Uber. And I've been an Uber customer for 10 years and I've had 1,000 rides on Uber and they've all gone okay. So yeah, I think I'll take an autonomous, robo taxi ride this time. I think the adoption rate could go up. That's my feeling about it. It'll certainly be a topic, a trend to follow and to see where that's going to land. But I'm a believer in Uber. I think I'm going to just keep building a position, maybe invest about 100,000. And I think it's going to be worth a lot more in the future. All right. So that is Uber. Thanks for hanging in there with me. I think was it Neil that asked about it, or I forgot who asked about Uber. Sorry, it took a while, but was able to cover it. Okay. So Goldman Sachs. So financial services did really well this year. Goldman Sachs did really well, 53% appreciation on the stock. And the stock's really been working for 5 years. So very nice. There was a plateau for a while, but man, starting October 2023, it really went up nicely. And it just seemed like most financial services companies were just, things clicked. Insurance companies made money, banks made money, companies that like Goldman Sachs, they're classified as a capital markets in the capital markets industry. They made money. I own Robinhood, made money. Coinbase made money. Everybody is making money in financial services. And I think financials are just going to benefit from a Trump administration. I think he's going to be friendly to the financial markets, friendly to banks, probably make lending standards easier. He's probably going to publicly put pressure on the Federal Reserve to move on rates and lower them, even though inflation might be a problem. So I think he's going to do things that are going to help Goldman Sachs and the rest of the financial services space. The PEs and so forth look pretty reasonable. I mean, you look at tech and Palantir's up to like 400 or something, some crazy number. And this looks like it's fairly priced according to what analysts are saying. And I own like Citigroup right now. It's discounted a little bit, not a wild discount, but it's a pretty solid, stock. I own Allstate. It has a pretty good discount. It's gone up considerably. I'm looking to get into Chubb as well. So Goldman Sachs, their growth has been good. Their revenue growth, 12%. It is a pretty big company, $49 billion. They had a pullback year on 2022 when stocks were really going down in value. Okay. So I'm going to go with what analysts are saying. I don't have anything, a lot to say about Goldman Sachs, and I'm not sure how to treat them. I don't think they're a bank. They're more like a Robin Hood. Their cash flow was negative, which is a red flag. I'll come back to that in a second. How many analysts cover this? 17 analysts cover it. They're saying it's a good buy, but it's priced a little too expensive. And they're basing that on earnings per share. And earnings per share is going to be growing. Revenue is going to be growing modestly. Okay. All right. So coming back to free cash flow. So you have net income. Their accounts receivable has been going up. That's what's causing a big drop in the operating cash flow. But how come this is negative 88? These numbers don't add up. I think this website isn't adding these numbers up right. This makes sense, right? You got negative 28. So this is minus because of this number. Accounts receivable went up a lot. You could see that it happened before in 2020. So what is driving this? So you got to get this explained, like what's going on here? Why? You got to look at their financials, go through their earnings. They had to explain that. That's a huge number. It's like, what's going on with accounts receivable? Why is that going up? Is it a big problem? Is it a big concern? Are you going to have to write off accounts receivable? Because that is going to be on people's minds. Historically, they do produce good cash, but I'm not seeing a nice, I like seeing smooth data, and this is not smooth data. Data's going all over the place. See how some numbers are positive, some are negative. It's not giving me smooth data. So I think there's homework to be done. You got to explain this number, establish a cash forecast that you think you can stand behind. It'd be hard for me to kind of forecast this because it's kind of up and down. And the economy should be good for Goldman Sachs. I mean, there's probably going to be more deal making, more acquisitions, more mergers in 2025 and for the following 3-4 years. I think acquisitions and mergers were kind of held back for the last 4 years. We had a Department of Justice that just hated big business, and it was irrational at times, in my opinion. I think they stood in the way of good things happening. But I think a new administration is going to be friendlier to business. All right, so that's Goldman Sachs. So the Chiefs, I think, scored another field goal. I believe it is. Score is 16 Chiefs, 7 Steelers. And we're in the third quarter with 12 minutes left in the third quarter. So there's plenty of time. But the Steelers got to score. Steelers are probably going to keep it close, and I wouldn't be surprised if the Steelers win at the end. We'll see. We'll see. That'd be interesting if it happened. All right, cool. So I think I covered everything. All right. So let me think for a second. So I think that's a good place to kind of land the plane. Everybody, Merry Christmas. Good luck with the stock market. We have 2 days going tomorrow and on Friday. I don't think we have a future pre-market number yet. Nothing. You know what is open is Asia. The Shanghai is flat. It ended flat because they traded today, Wednesday. They're ahead of us like half a day. Looks like in Japan, stocks traded up a little bit. And China did they were looking great like 3 months ago. It looked like China had awakened and Chinese stocks were going to do well, but they kind of had a couple good weeks and then nothing after that, which was kind of disappointing. So it is what it is. All right, everybody. Thanks for tuning in. I appreciate you. I'll live stream tomorrow at the beginning of the market session, like around 10 a.m. Eastern, 7 a.m. Pacific. And I'll probably live stream in the evening as well. Try to do those 2 sessions this week. And look forward to seeing you on those live streams. Then on Saturday, just a reminder, I'm going to live stream with Scott, with Scott's Due Diligence at 11:30 Pacific, which ends up being 2:30 Eastern. If you'd like to be part of the investor calls we have an investor call where we get on a conference call. We talk about stocks. We talk about topics on, improving one's stock investing skills. We have 2 sessions on the weekends. One's a workshop, more for hands-on skills improvement. And then the other one is just talking about stocks and investments. You can go to those. You just have to be a paid member. And the memberships, the details are in the description of the video. Take a look. It'd be great to have you on the weekend sessions and have you be a part of that. There's also a Discord, and the Discord is pretty active, and I invite you to attend that as well. All right, everybody, take care. Thanks for tuning in.